So this week turned out to be one of those weeks where, as a trader, you're reminded that you need to adjust or adapt to the change in market conditions. And with that being said, we're going to break down the news that we got this morning for payrolls and what that means for markets moving forward. All right, so let's go ahead and break down what we got today. First and foremost, elephant in the room. There we have it. There's your verdict. Payrolls, minus 23,000 jobs added to the US economy. Not only that, right? Not only did we miss the forecast of 85,000 for the month of July, but we also got revisions lower from the month prior from 57,000 to 20,000. Now, we did get a little bit of mixed data, right? Unemployment rate obviously edged slightly lower from 4.2 to 4.1, which is a positive, but markets were primarily focused on the condition of the labor market regarding how many jobs were added to the US economy and what that means moving forward for interest rates. I think that's the main topic of discussion. As per the last video that I did with you guys, we talked a little bit about interest rate expectations, what that means for markets, and what today's reports could mean for markets moving forward. Now, before we get into the expectations for rate hikes and what those look like now versus what they looked like 48 hours ago, here's a really good breakdown that was just released about 14 minutes ago from Think ING. Surprise US job weakness casts serious doubt on Fed rate hikes. So just to give you guys some perspective, previously there was expectations that the Fed was going to hike in September, and that's kind of what kept the dollar index, for example, relatively supported around 99.5. So if you turn over the dollar index on the left hand side here, it's what kept the dollar supported here at 99.5 was the thought that, hey, we could get some sort of a rate hike in September. And so let's go back to this here. The US lost jobs in July, and while the unemployment rate fell, it was for bad reasons. Rate hike expectations have declined, but there is a lot happening before the 16th of September FOMC meeting. There definitely is. So that's the actual number that we got, minus 23,000. The US jobs report for July was surprisingly weak, with payrolls falling 23,000 while there were 103,000 of downward revisions to the past 2 months, leaving the 3-month average, at 20,000. The unemployment rate fell to 4.1 from 4.2, but not for good reasons. It was primarily because of a further drop in the participation rate, unemployed people leaving the workforce entirely. Average hourly earnings growth slowed to just 3.2% year on year from 3.5. In terms of payroll details, the leisure and hospitality sector lost 40,000 jobs, which may reflect the conclusion of the FIFA World Cup, but we also had seen a 43,000 drop in June when it was in full swing. The financial sector lost 14,000 roles, while retail lost 19,000. The offsetting strength was in construction, 22,000, and as usual, private education and health care services plus 25,000. The chart below shows the cumulative job creation since December of 2022 and indicates that after a decent March and April, we have reverted to the very weak trend experienced from January 2025 to February 2026. So it's the cumulative increase in US employment since December of 2022, based off of the different sectors, right? But the overall message here is, hey, big downside surprise today in payrolls data. And what we saw as a result of this, if we take a quick look here over to the CMEs, as a result of this is in real time, by the way, the expectations for a rate hike for the month of September have dramatically increased. It's crazy because previously these two were switched, where the 3.75 to 4% interest rate expectation was well above 50%, while the current interest rate was below 50%. It was like, I think it was sitting somewhere around 40 something percent. And now the roles have changed. And the reason for this was due to today's payrolls report. So the fact that we're not seeing aggressive growth in the labor market kind of pushes back the idea that the Fed might have to hike for the month of September. Now, what does that mean for the month of October, right? Look at October, 3.75 at 46% versus 3.5 at 42%. These two are very, very close. Then you look at the last month of the year, 3.75, 44%. So the story here is that because those rate hike expectations are now being pushed back even further, arguably there's questions around whether we're even going to get a rate hike for the rest of this year at all. And now what that did as a result of this is, if we take a quick look at the US Treasuries fell below 4.2%, slightly dipped almost to 4.15%. Right now we are getting a bit of a pullback here, but added to that downside pressure that we had initially seen in the index, falling slightly below 99.5. So now the question here is, and this is where things start to get very interesting, because if rate hike expectations are being pushed further away from markets, and that's causing dollar index to stay under pressure, what does this mean for commodities? What does it mean for commodities like gold, for example, right? Gold has been absolutely soaring prior to today's payrolls report, but now that we got those figures this morning, all this is really going to do is add more steam for gold to continue to price in higher. So now you think about, okay, what are the pros and what are the cons behind the idea that, hey, dollar can stay under pressure, could continue to trade lower, right? Versus it recovering and starting to head back north. The real, I would say the only thing that's really getting in the way of further dollar downside would be if tensions in the Middle East start to flare up again. So if peace deals fail, if peace talks fail, ceasefire talks fail, and we start to see the reemergence of the war escalating further, then that's going to cause more demand, safe haven demand, into the likes of the dollar index, right? So that's really the only, I guess you could say, headwind that I could see over the short-term period, since we don't really know what's going to happen over the weekend. A lot can change. I mean, if you look at oil prices right now, we are trading at $77 a barrel. So we're not that far off from pre-war levels, right? We were back in February, right before the war, we were at $67 a barrel. Right now we're at $77 a barrel. So we're not that far off, but nonetheless, the fundamentals at the moment, right? The data is pointing towards, hey, further gold upside, further dollar downside. Now, the biggest question here, especially next week, because next week we have inflation. If inflation next week comes in cool, right? So if we see inflation easing, then what that'll do is it'll completely open up the gateway for dollar index to continue to sell off even further. And so I think that's the main thing that markets are going to be paying attention to as we approach Wednesday of next week, is the inflation rate. What's that looking like? How can that impact, right, interest rate hikes even further than what we've seen today? And what does that mean for instruments like dollar index? What does that mean for commodities like gold? What does that mean for treasuries? You know, for the short end of the curve, like the 2-year yields, what does it mean for all of these things? So for the time being, I definitely do step back on the idea or the bias of wanting to buy the dollar. And if the fundamentals continue to support dollar weakness, then that's what I'm going to be trading moving forward, right? But that's the current update that I have for you guys. I would be very mindful of what happens over the weekend relative to Middle East, you know, what developments we get from the Middle East, and how the market sets up from now till, of course, Wednesday of next week when we get the inflation report. So that's pretty much it. Obviously give you guys another update as we get closer to Wednesday, and we'll pretty much take it from there.